How did the process feel? And what if we told you we're going to start a company that did this? How would you react? We just wanted to have the feedback from them.
Yeah.
We left that weekend with over $2 million in commitments to invest if we started the company. So that was like validation of model right there, right?
Yeah.
So by the time we came back to them a year and a half later and said, hey, we've done the work. Your investment goes directly
Hello, everyone, and welcome to another episode of the podcast. Today, I'm excited to host our guest, Zwade Marshall, who's an anesthesiologist and pain specialist and the co-founder of the Doc2Doc lending service. So I just want to get Zwade to tell us about his story as we're getting started. So Zwade, just if you could tell the listeners a bit about yourself, your background, and what inspired you to create this lending service called Doc2Doc.
Robbie, it's a pleasure to be here with you in the Viking Capital Network. Thanks for having me. Indeed, I am a CEO of a lending company and a physician that's in practice. Today, I'm actually in the clinic, and hence the white coat. It's not just a costume, so to speak, but I did see patients this morning, and I thought it was apt for me to continue in the dress of a doctor. But I was born and raised in the Caribbean, moved here when I was 17 years old, and went to college at Emory in Atlanta, did medical school there as well. At that time, this is in the 2006, 2008 period when the Affordable Care Act was being contemplated. And I had a keen interest in understanding business. So I did the MD, MBA, and it wasn't a formal program at that time. It was taking time out of medical school to go do the MBA, which I did. I had a focus on operations and organizational leadership and went back to medical school, finished my fourth year, and did anesthesiology as my residency at Harvard and interventional spine management fellowship at Harvard as well. So returned to Atlanta in 2016 and started to work for a large private equity backed pain practice. And COVID happened. And like most folks that were employed at that time, had this epiphany about why I was doing what I was doing and where I found my place was in the world, and decided to open my own practice shortly after the pandemic started and did that. But to your question more specifically, the Doc2Doc lending platform, when I was leaving Atlanta, Emory, to go to Harvard in Boston, I was leaving a relatively low cost of living city to go to one of the highest rental markets in the country. And at that time, I had 220K of student loan debt. My FICO score was considered to be subprime, and my income as an intern at Harvard was $13.12 an hour. So I didn't have the 17K needed for last month's rent and broker fee, and tried to borrow the money and was dismayed to realize that the banks viewed me as a high risk borrower because of my credit profile. And they had no regard for the toll that medical education and the expense of it takes on a young physician's credit profile, right? And so like we're mortgaging our youth to pursue this career of service. And so when I got denied or approved at a credit card interest rate, it felt unfair. And that was the inspiration for the company starting, that we as Doc2Doc underwrite our loans more thoughtfully about a physician's journey. We care about your specialty, how many years you've got left in practice, where are you going to be practicing, what is your free cash after you've paid your bills, all criteria to help to give them a leg up to getting to yes in the underwriting criteria, but also getting them a better interest rate than they otherwise would be approved for. And it's gone very well.
That's excellent. And, I love those types of stories because it's often the hardships that we experience in life that are motivating factors for us to create something new or think of, a new perspective. And I do want to talk about sort of your entrepreneurial spirit and how you went about creating that, this platform. But before I do that, let me just ask you a little bit more about Doc2Doc since we started going down this path. Can you describe, how it works, how a physician could take advantage of this platform?
Sure. Yeah. Thanks for the question. And it is indeed hardships that I think resonate most in motivating us. And I can never forget how it felt to think I've just won this lottery ticket to go to Harvard for my residency, and then I just don't have a way of getting there, and my parents couldn't afford to write me a check. And so it felt so helpless, right? And that's the kind of thing that motivates you. You remember it. And I recognize it in the borrowers that I speak with now, that when I say you're approved, and we give personal calls, Dr. Gupta, this is Dr. Lumley, one of my partners in the fund. We've got an approval for you. And folks will literally cry on the phone
Wow.
because they've been denied 4 or 5 times before they found us. And so it's extraordinarily rejuvenating to be able to do this. We've got a platform and a website, doc2doclending.com, and it's a frictionless application process, meaning it takes 3 minutes. It's all virtual. My entire team, and there are now 27 of us in the company, it's virtual. So there's no brick and mortar store. They go to the website. In 3 minutes, they put in their demographic information. So it's name, specialty, income, and we do a soft credit check, not a hard pull. And we're able to give a conditional approval within minutes, 3 minutes, or a denial if someone does not fit into the hard knockout criteria. And that would be things like prior bankruptcies or active collections accounts.
Okay.
Once approved conditionally, they got a call from a doctor in their team to say, welcome to the family. Here's some things to know about us. Number one, we have no prepayment penalties. So should you have a windfall of cash, you begin to moonlight, your family members give you a check after you start your program or whatever, you can pay us off at any time, and we don't charge any fees for the interest that we lose. We give auto pay discounts. We've got a number of features in the program that's very helpful to our doctors. And then we can fund that loan within 3 to 5 business days by just checking on their a true credit pull at the time of disbursement, and also verifying their income and an identity, all done virtually. And so it's been very seamless. We lend up to $25,000 for folks that are still in training, and up to $100,000 for folks that are in practice already. And we've done north of 112 million bucks in loans over the course of the past 3 years.
Wow, that's amazing. And I remember also trying to get a loan. It was sort of a different period of my life. I was working as an attending and had reasonable income. And my credit score took a hit because I didn't even realize that I had to pay some utility bill. And it
Yeah,
was the most ridiculous amount. It was like $30.
that's right.
And I didn't pay it because I moved from, it was actually, I moved from Chapel Hill, North Carolina, where I did my training. I was at Duke as well for a year after that, but I moved and I didn't see that bill and I got docked and I couldn't get a loan because my credit score took that hit. And it took a while to get that
Off.
erased.
Yeah.
But do you see people like that where they have poor credit but otherwise are good applicants?
All the time. So we have a hurdle within our underwriting to say if there's a collections account beneath a threshold of $500, we're able to not count it against the doctor because we know
Okay.
these things happen. And so you'll find that our underwriting is very attuned to the experiences that we share in our community. It's the same things that happen for all of us, right? Like
Right.
it's the cell phone bill from college that comes through. It's the light bill that your roommate should have been paying that they didn't pay, and now it's your name was in the lease. And so
Right.
like we know what happens here, and we also know that you've got this dermatology residency to get through, and after you're done in 2.5 years, you're going to be making $450,000, or you're in practice already and making a good income, and this is a non-issue to your
Right.
ability to pay. And so I brag that we've done 112 million in loans. What I should have said at the same time was our bet that a physician borrower with a suboptimal credit profile will still perform better at repaying loans than a non-physician, because we understand the career cycle of a doctor. And this is a time in the American economy where it's been really, really tough in consumer lending because interest rates are at an all-time high, and you're seeing that defaults and delinquencies are at an all-time high. Our competitors like SoFi and Panacea, they're seeing spikes in the overall loss curves for their portfolios.
Yeah.
Our portfolio outperforms the tier one super prime credit profile doc folks at SoFi do not perform as well as our subprime portfolio of doctors within Doc2Doc. So default rates for us are less than 3%. For SoFi, it's north of 3.5% for tier one credit compared to our 650 FICO score borrowers.
Right. Wow, that's amazing. I mean, it just goes to show you that you're selecting within a group of individuals that obviously, they care about their financial status. They are high income. They have high income potential. So it makes a lot of sense that you're not going to get these high default rates. What kind of interest rates do you charge?
Yeah, so our best rate is 8.9%. And again, this is a consumer unsecured loan, no collateral. And our nearest competitor for a 5-year term loan is at 9.37%. So we're best in class there. And we go up to 24.9% for folks that are credit down to 600 is our minimum credit score. So others lend down to a 680 minimum credit score, but yet their highest rate is 33% for many of the others. And so we cap our highest rate lower than others and lend down to a lower FICO scores than others would.
Okay. And you would have to pay a higher interest rate if you have poor credit or any of those other negative hits on your credit score, I imagine.
Exactly right. Poor credit, low free cash. So after you've paid your bills, you've had very little cash remaining to cover the cost of the loan. Elements of poor financial kind of repayment history. So folks that have had sloppy payments in past, that portends a higher risk of having sloppy payments with us.
Okay. Okay. So I mean, there is a potential to pay a high interest rate, but at the same time, you're working with people as long as they have good credit, you're still dropping it to as low as you can to be the best in class for an unsecured loan.
Absolutely. Yeah. And like the terms, like high interest rates relative. If someone has a 620 FICO score, there's no interest rate that anyone else will give them. There's no rate. It's a
Yeah.
denial, right?
Right.
So then they think, okay, now is it worthwhile for me to pay the 2% per month, right? Because think of it as a monthly rate. It's a 24.9% annualized APR, but there's no
Right.
prepayment penalty. In our lives as doctors, there could be a real need for cash to solve an immediate problem. That problem will not persist for the 5-year term of that loan. Should you be able to solve that problem in 3 months, you would have paid us a total of 6%, and there's no fees to get out of the loan.
Yeah.
So it's a no obligation, no hold, no lock in. It can help you get over that hurdle for that transient period. And that happens to so many of us. So the
Yes.
folks that obsess about the rate are missing the point. If you don't need the loan, don't take it. Don't
Yeah.
borrow if you don't need it. But many of us need it.
Yeah.
But for some source, something is happening in our lives. We need that money, and we make it easy for you to do so and get out of it because we want you to get out of debt. Should your credit profile improve while we've given you a loan, we can also refinance you in seat to a lower rate with us, right?
Okay.
So we will even change the terms to say, hey, you're eligible for a 15.9% loan now or 11.9% and give them a better, because for this model to work for us, we don't thrive on the spread of the interest rate. That's not how our company value is derived.
Right.
It's really the lifetime value of our customer. It's being the USAA for doctors. It's treating them well enough that they come back and they trust us. And I know that we have their best interest at heart because we are just like they are. And so this the repeat recurrent business and being able to offer other products beyond personal loans over time is what drives enterprise value. So I'm motivated to give you the best rate possible and keep lowering the rate so you remember Doc2Doc did this for me when no one else did. And when I need med mal insurance or disability insurance or a practice buy-in loan for $500,000, I'll trust those guys over Bank of America.
Yeah. Well, that's great. That's wonderful. And you mentioned the spread. How does it work with, I'm kind of going deeper into how your company functions, but how does it work with the money that you have, the pool that you have to lend from? Are there investors that invest into Doc2Doc, and then you sort of play off the spread? How does that work?
That's exactly correct. Yes.
Okay.
So there's two types of Doc2Doc investments. There's the equity investment, and that capital does not go to loans. That goes towards the company growth. It's paying for the team. We've got a professionalized CFO and chief of risk, et cetera. It goes to marketing. It goes to speaking at conferences, et cetera. Then there's the debt investment. So we got to have a Doc2Doc income fund where physicians pool their resources with us and they get paid a 10% annualized return that's paid monthly, right? And
Okay.
so everything north of 10% would be our spread. And that spread is divvied up into the cost of originating the loans, it's the servicing of the loans as well. And so we will take care of costs and have the margin spread around that as well. We have raised $155 million in debt capital over the course of the last 3 years. We've partnered with a bank in New York called DR Bank, a credit fund in California called Revolutionizing Capital Partners. They buy our assets when we originate them. And then we've got the physicians that give us debt capital and get paid a monthly return on that as well. On the equity side, we do equity raises about once every 18 to 24 months. And we're just embarking on a raise right now after having done our last raise a year and a half ago.
Interesting. Okay, so you have in your capital stack, you have a debt and equity structure. On the debt side, you have lower interest rate debt from institutional providers,
That's
and
correct.
then okay, and then you have a debt fund which gives a higher interest rate debt to kind of make up that sort of that ground. And then you also have equity investors that are coming in. Probably it's a riskier investment, but better returns
That's
in
exactly
essence.
correct. Exactly
Okay.
right. Yep. It's a
Okay.
high growth early stage company, and so it's high risk but high reward as well.
Right. And maybe you can tell us about that. What is happening with this tranche that you're raising?
Yeah. So we raised again $18 million in equity over the course of the last 3 years. And it's really from our network of physicians. And we've had a number of repeat investors over the course of the past 3 years. $100,000 invested in our first round in 2000 is worth $587,000 today. We did, the first year we did 2.3 million in loans, second year 13.6 million, the next year 36 million. We're on pace to do 55 million this year. And so the growth has been impressive. At the same time, the performance of the assets, the defaults and delinquencies have been as expected, very low, best in market. So we've been able to close every equity round oversubscribed at times when other companies like ours couldn't raise money. For instance, our last equity round was done last spring, shortly after Silicon Valley Bank crashed. And credit markets were in disarray and no one could raise money at the time in the lending world. And I was looking to raise 10 million bucks and got 11.8 million and turned away $1.8 million. We didn't take it because we were full,
Yeah,
And
that's
so,
amazing.
and it's because doctors get the story, they get the mission, they understand what we're doing, and it makes it a lot easier for us to raise capital. So we're at the point now where this kind of inflection point, where we're going to go from being an early stage, call it a startup,
Yeah.
to now a high growth mid stage company. Okay. And we need to raise $20 million from an institutional investor over the course of the next 12 months. This would be the last opportunity for us to get retail doctors in before an institution comes in and finances the company. But our goal is to have doctors comprise the majority bit of equity. So with 18 million already on balance sheet, another 5 million in this round takes them to 23 million compared to the 20 million from the institutional investor that will likely get in the next year. So this round will be a safe note, a simple agreement for future equity at a 10% discount to the future Series A investor who will negotiate for the best terms for their credit fund or their insurance, whoever they are. And
Right.
so our current day investors get to benefit from the future investors' negotiations and get a 10% discount of that. So for easy math, if future investor negotiates $1 per share, the folks now will convert at 90 cents per share.
Okay. Excellent. So it's worth about 10% more.
That's exactly right.
Process.
Exactly 10%.
Okay. Excellent. If this is something that interests you, we're gonna obviously have your contact information and also mention that it would be helpful to us to mention that you heard this on our podcast. So just mention that when you're talking to Zwade about this particular interest. But it sounds like this podcast is being recorded mid-July. So sounds like this potential will be open for another, you said about a year, right? Until you fill up or
Until
until you
we
fill up.
until we fill up, yeah.
Okay.
So we anticipate probably having this run for the next, I'd say 12 weeks.
Okay. Excellent. Okay. Perfect. Well, this is an opportunity for folks that are interested. Let's pivot now to discuss just your entrepreneurship and how you formed this company, because it's really amazing what you describe and how you're solving for these issues that physicians have. And it resonates with you, it resonates with me. I was in a position, I remember, during residency where I had to rent a room, in a small condo so that I could make ends meet. I was paying my own way through it. But luckily I was in an area that wasn't expensive like Boston. As I mentioned before, it was Chapel Hill, so it wasn't like the rents weren't so high, but still I needed that extra income. So a loan at that time would certainly have been helpful. Give us some advice to health professionals looking to start their own venture, their own initiatives. Maybe they're inspired by a story of their own. How did you start this?
Yeah, I think so many of us in medicine spend, more than a decade in school doing the basic sciences and the practical sciences of becoming a doctor. And then we get to the point of practicing and realize that we've got these other disparate interests that still make us who we are. We want to find ways to scratch those itches, right? For me, I think that the lessons that I've learned in this entire journey so far has been the things that made me good at succeeding through college and medical school and residency and having a practice also makes me good to some degree at other leadership roles. They're different, but there's some transferable skills. For instance, we tend to have grit. We're not afraid of the hard work and the hours that we have to commit to seeing a project from beginning to completion. So know that you've already been tested and proven by virtue of the fact that you survived medical training. All right. So that should inspire some confidence in your personal abilities. Because most times we feel like imposters. We've all had the imposter syndrome going from med school to residency. You're a Duke. I'm like, should I even be here? Like these kids are smarter than me. And somehow we make it work and we're there. So that's number one. Like we've been tested and we have an aptitude for work and for doing things well. I think starting with a problem that you've personally experienced creates a level of passion for the mission. The money comes eventually, but if you understand the problem that you're solving and you're creating a product and you can have a value proposition that speaks directly to the problem and the emotional experience that you faced, it bodes success. I think what I was surprised by and what I was afraid of most in my line of business is my product is money. So success means I have to keep raising money. And I had no level of comfort with that. I think my peers that invested in the very first round, they did not understand what lending companies do. They didn't get how interest rates work and how defaults and delinquencies and all the things that go into this business. They were trusting Zwade Marshall, the doctor, who they knew as being a high integrity physician. And they just presumed that I was going to do a good job with their money when they invested in the company. And that created almost crippling pressure at the beginning where I I found that like my co-founder and I, Dr. Kenton Allen, who went to Harvard with me, we decided to self-fund the initial infrastructure of the company. So a lot of legal due diligence, like we were writing six-figure checks to attorneys to get the company infrastructure put in place. Then self-funding the tech and getting the website and the loan applications. We didn't want to have investor funds go to overhead. So by the time we told our peers, hey, we've got this business idea, and we did a pitch actually at the American Society of Anesthesiology conference in 2018. It was hosted in Boston that year. And we didn't have a vendor booth. We squatted at the Starbucks in the conference hotel. And as folks came by, we said, hey, we got a question for you. Did you borrow money when you were in residency, whether it was for transition from med school to residency or to make ends meet? And we want to hear people say yes or no. And then how much did you borrow? And what if we told, and what was your rate? How did the process feel? And what if we told you we're going to start a company that did this? How would you react? We just wanted to have the feedback from them.
Yeah.
We left that weekend with over $2 million in commitments to invest if we started the company. So that was like validation of model right there, right?
Yeah.
So by the time we came back to them a year and a half later and said, hey, we've done the work. Your investment goes directly towards loans. So we've mitigated the risk for you. It felt a lot easier to make the pitch. Over the course of the last 3.5 years now, I've gotten a lot more confident in raising funds because we've performed so well that at this. So back then I used to tell my friends, hey, invest whatever you can afford to lose, and don't give me a dime more than that because I would know where this is going. And it's now become when folks are asking me to create room for them because we're overfunded and oversubscribed, but it's going well. And so that's been a beautiful part of the arc. And with growth comes, problems of growth. We're managing a larger team. I have folks reporting to me that are seasoned professionals. Like my CFO's built his career 30 years at Bank of America Merrill Lynch, and he reports to me, and I need to be able to challenge him with questions to ensure that he remains motivated, inspired to do the work of the company from a financial perspective. And that creates its own unique challenges to stretch my own leadership skills. So I have a CEO coach that I meet with weekly to discuss, people management, strategic elements of the company as well. And so I feel super fulfilled because I'm able to scratch both the entrepreneurial itch and a mission-driven passion project that's also making money.
Yeah, that's amazing. There are a lot of your stories that you just described, and the mindset, imposter syndrome, all those types of things very much resonate with me because when we started our company, I went through the same type of struggle. It's like, you have an idea, you have an emotional tie to it, you've got the mindset that you want to, you're focused, you're goal directed, you want to create this company, you've got a vision, you've got a coach in place. Coaching is so important because that's, like just as you mentioned, you have a CEO coach. We had multiple coaches that help guide us. But then it's just that resilience, it's just not being afraid to make a mistake and just put one foot in front of the other, understand that there's good days and bad days, but you will get to ultimately to your goal. And it's amazing how far you've gotten. And it's an idea that makes complete sense to me, Doc2Doc lending. It just absolutely makes sense. And it's, when you have an idea like that, when you see somebody as successful as you've been, you kind of think like, hey, why don't I have that idea? It just makes so much sense, and your idea makes a ton of sense. So just kudos and congratulations to you for building what you have, and it sounds exciting and where you're going.
Thank you.
Absolutely. And let me ask you, as you see the company growing and unfolding, like what are other opportunities for physicians to get loans, to get some kind of financial benefit from your platform?
Yeah. So no, thank you for all that you just shared. And I think there's this like kinship amongst entrepreneurs, right? Where you have to wake up as the eternal optimist, and you got to put yesterday behind you and look forward to tomorrow's going to be a better day at all times. And so I think Viking Capital and Limitless MD and all these, there's a cadre of physician advocates that are just touting that we should be more supportive of each other. I think our company does that. Yours does the same thing, and we all kind of will tell stories that just ring a bell to each other because like we've been there together. We know what it means to have the anxiety, the hardship, the challenge, the doubt, and all the things. And so it's great to be here because of that. I talked a lot about the in training resident physician needing money and transition costs, and that's the number one reason why in training doctors borrow from us. But we've got half of our portfolio in terms of funds deployed have been to established doctors, right? The number one thing is for debt consolidation. They've got higher interest debt. It could be credit card, it could be a factoring loan or a loan that's collateralized by their practice collections. That's just kind of killing them because they're having weekly or bi-weekly draws out of their coffers. So they'll consolidate that with us. It could be an expansion. So they're getting a larger loan from a Bank of America, but they need to have their equity part of that larger loan. So they're going to borrow $600,000. The bank says you need to have 150K of your own money. They'll borrow 75 from us to put with their 75 because this is a personal consumer loan. We have a Doc2Doc credit card now that has 0% APR for the first 6 months. So folks will do balance transfers. The investor community that does real estate fix and flips love our product because they'll borrow 100K from us, do the renovation, do the flip, do a cash out refinance and pay us back because we have no prepayment penalties. And so they'll use our loan kind of like their own line of credit where they can kind of flip, repay and do it again and again and again. And so there's a ton of use cases. We say it's the life happens, anything loan. We don't, any legal reason to borrow, you can use our funds for. We only ask why you're borrowing for our own data mining purposes, but we don't put any restriction on use of funds. So folks use our loan for fertility treatments, for IVF, for oocyte cryopreservation, for business use cases, to float payroll for 3 months while there's been a disruption in their insurance collections. It's whatever. We're just here to support doctors.
And it's only physicians that can apply for this loan.
And dentists.
And dentists.
And dentists, yes. We are expanding now to podiatrists and to doctors of pharmacy. That's part of our product growth cycle. We think that we'll eventually serve more health professionals, but our flagship product is the doctor loan, physicians and dentists.
Yeah. Excellent. Well, Zwade, this was very insightful, and I really appreciate your time and sharing your story with us. Do you have any final thoughts or messages you'd like to share with our listeners?
So, Ravi, thank you for having me. It's a pleasure to be here. I think that it's always good to speak with audiences of like-minded folks that kind of get the joke, right? It's incredible. I've spoken about the company to non-physicians quite a bit, to different funds and bankers, and it takes 3 to 4 recitations before they get they're like, why would a doctor need to borrow money from you guys? Like, they're more like, what are you talking about?
Yeah,
And they
yeah.
have no idea. But you tell a doctor audience, they're like, yeah, that was me, right? It's so simple because we've all lived it. And so it's a pleasure to be here. I think I'll say that we are really aspiring to be the USAA for doctors, right? Like, there's this strong emotional brand connection that veterans have with USAA. They trust that company will provide them with the best insurance, the best home loans, the best consumer loans, because they get the joke. If you call USAA and you say you're an E6, the person on the other end of the line knows what that means. In our world, you tell us that you're a 3rd-year neurosurgical resident, we know exactly what that means. We know what your daily life is like. We'll communicate with you at 11 p.m. Eastern time or on Saturdays and Sundays, right? Like, so we meet our doctors where they are when they need us most. And that's our value. And we're a mission-driven company, still led by doctors. And we love what we do. I take some of the borrower calls myself every week just to remain close to the need. I love to hear the stories. I like to hear the reaction of folks say, hey, I heard you speak. And
Yeah.
I enjoy all of it still. So it's been an incredible journey, and we'd love to partner with you guys. And if any of you listening has an interest in investing and you're an accredited investor, and look up what that means, but we'll talk you through it if you do reach out. Happy to do it. And then you can contact Ravi and he'll get my info to you as well. But it's a pleasure to be here. Thank you.
Thank you,
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.